Most traders don't blow up because of one catastrophic trade. They bleed out from 50 small, stupid ones that felt harmless in the moment. You know exactly what that feels like. You sit down Monday morning, tell yourself today I'll be disciplined. You take your first trade, small loss. No problem. Second trade, scratch. Third, tiny win. You look at your P&L and it's down a bit, but you're calm. I just need one good trade to get back, you tell yourself. So you keep clicking. By day's end, you've taken 14, 18, maybe 22 trades. You're mentally drained, emotionally fried, and your account is down another few percent. You tell yourself you'll make it back tomorrow. You won't. Not with that behavior. Here's the brutal truth you don't want to hear if you're taking 10, 15, 20 trades a day. It's not hustle. It's not being active. It's an addiction. And the market charges withdrawal fees. Every impulsive trade is a transaction fee on your lack of discipline. Picture this scenario. You start Monday with $10,000 in your account, not imaginary money. Butte your savings, your shot at changing your life. You. Restaying active with 12 trades per day. Eclasticity, just 0.5%. Of your account. $5 per thousand. No big deal. You tell yourself. That. Slunch money. Boo there. Stim off trade at times 0.5%. Average loss equals 6% in dollar weekly drawdown. That's before the emotional damage. Let me show you what this looks like in real dollars. Your 10,000 account losses 600 in week 1 from those tiny cuts. You're now at 9,400. Week 2, same pattern. You'll lose another 564 because you're calculating losses on a smaller base now. You're at 8,836. By week 4, you vebbled out over 2,000. Not from being wrong about market direction, not from missing a stop loss on a gap down, from death by 1,000 paper cuts. Meanwhile, the professional who started with the same capital took just 2 trades per day. Some days only 1. Occasionally none. 2 trades Monday, 1 winner at 1.2%, 1 scratch. Tuesday, no setups met his criteria, 0 trades. Wednesday, 1 trade up, 0.8%. Thursday, 2 trades, 1 winner at 1.5%, 1 small loss at 0.4%. Friday, 1 trade up, 0.6%. He finishes the week up 3.7%. That's $370. Not life-changing money, but he's moving in the right direction while you're hemorrhaging capital. The difference isn't intelligence, it's not access to better information, it's identity. The amateur asks, what can I trade next? The professional asks, what deserves my capital today? That single question shift changes everything. When you ask what you can trade next, you're seeking permission to act. Your brain wants stimulation. You're treating trading like entertainment, where the goal is staying busy. When you ask what deserves your capital, you flip the script. Now the market must prove itself worthy of your attention. You're no longer a desperate buyer of action. You're a selective allocator of scarce resources. Here's what makes trading unique among all professions. It's the only job where working harder, defined by number of actions, often guarantees you'll make less money. If you lay more bricks, you build a bigger wall. If you write more words, you finish faster. But in trading, more activity usually means more losses. The market doesn't reward participation trophies. It pays the patient and punishes the restless. Professionals know this maxim. Activity is not productivity. In trading, activity is often the enemy of profit. Today, I'm handing you a constraint that will feel like a straitjacket. The 2-trade rule. 2 new positions per trading day. Maximum. No exceptions. No rationalizations. Not 3 trades because you're feeling good. Not 4 because you spotted extra setups. 2 trades. Period. Notice what happens in your body when you hear that. There's resistance, right? You're already negotiating with it. But what if the market is hot? What if I miss the move? That voice is exactly why you need this rule. That voice isn't your edge. It's your addiction talking. You'll hate this rule at first, because it exposes something deeply uncomfortable. Most of your trades aren't logical decisions. They're emotional reactions. Fear of missing out. Boredom. The urge to win back what you just lost. When you know you only have 2 bullets for the day, you can't keep firing at every noise on the tape. You transform from a machine gunner spraying bullets into a sniper, waiting for the perfect shot. Think about it. If you had unlimited bullets, you'd spray and pray. But if you only had 2 rounds and were hunting to feed your family, every shot would be carefully aimed. You'd wait for the perfect moment. You'd control your breathing. You'd squeeze the trigger with intention. Let me give you a real example. A trader I coached, call him Mark, came in with a 20,000 account, taking 15-25 trades daily. Tiny size. Constant action. His chart looked like machine gunfire. He. To finish most days flat, sometimes slightly green. Butha's statement stole the truth. Commissions, slippage, and tildes were bleeding him 10% dollars monthly. We implemented the 2-trade rule. Day 1. He hated it. Took his 2 trades by 11 a.m., both small winners. Then the market opened up in the afternoon, and he saw 3 more setups he would have crushed. That night he wrote, "I left so much money on the table. This rule is holding me back." I made him do something simple, mark exactly where he would have entered and exited those missed trades. No hindsight, strict rules. You know what happened. 2 would have been losers. 1 would have been a scratch. The profitable day he carried in his head collapsed, under evidence. The 2-trade rule didn't cost him profits. It saved him from fantasy. Over the next month, his trade count dropped from 8,100 per week to under 15. His drawdowns shrank. His stress dropped. His confidence grew. He didn't become a genius. He just stopped giving his capital to boredom and impulse. That's what this rule creates: scarcity. When trades are unlimited, you treat them like cheap casino chips. When you're locked to 2, every decision feels heavier. It should. That weight forces you to behave like a professional. We'll break down why overtrading hijacks your brain, how scarcity creates better decisions, and the exact daily protocol of a 2-trade professional. You'll see why professionals sometimes sit all morning without clicking once, and why that doing nothing is actually holding a very specific position. But here's the twist. The 2-trade rule isn't really about limiting you to 2 trades. That's just the visible part. Underneath is a 3rd invisible trade you make every single day without realizing it. You don't see it on your platform. It doesn't show on your statement. But it decides whether you end this year as a professional or stay stuck as an amateur. That invisible trade determines whether you ever master this game. When you have unlimited trades available, every setup starts to look tradable. Your brain can't discriminate. A mediocre pivot gets the same consideration as a textbook breakout. Why? Because there's no cost to being wrong about which one to take. Think about walking into an all-you-can-eat buffet. What happens to your decision-making? You pile your plate with things you'd never order off a menu. You grab the fried spring rolls even though they're mediocre. You take 3 types of dessert. Why not? It's all included. No consequences for poor choices. Your standards plummet because abundance removes accountability. Trading with unlimited daily trades creates the exact same mental environment. That sloppy consolidation pattern? Sure. Why not click it? That stock barely holding support? Might as well try it. You're not asking if it's good. You're asking if it's possible. And in markets, almost anything is possible for brief moments. That's the trap that kills accounts slowly. This is where the amateur brain fails catastrophically. You see 5 setups and think, "I'll take them all." Your internal narrative sounds reasonable. Diversification. More shots on goal. Increase my odds. But here's what really happens. You're not trading 5 high-probability setups. You're trading 2 genuinely good ones and 3 mediocre ones that dilute your edge like water poured into pure juice. Let me show you the math that proves this. Say your A-grade setups win. 65% of the time with a 2-to-1 reward-to-risk ratio. Your B and C-grade setups win maybe. 45% with 1.5-to-1 ratios. When you blend them together in your daily activity, your overall win rate drops to around 52% and your reward to risk compresses to 1.7-to-1. You've taken a winning system and averaged it down to barely break even by including trades that don't meet your standard. Every mediocre trade doesn't just lose money, it consumes your mental capital. It spikes your cortisol. It makes you doubt your system. By trade 7, your willpower is shot. You're running on decision-making fumes. That's when you make the truly stupid mistakes that wipe out weeks of careful gains. Now impose the two-trade rule. Everything changes. Suddenly you have exactly two chances. That marginal setup at 11, and that sort of looks like it might work. You hesitate. Your finger hovers over the mouse. Then you ask the critical question. Is this really one of the best two opportunities I'll see today? That hesitation is scarcity psychology at work. When resources are limited, humans become better evaluators. We discriminate more carefully. We weigh options against each other instead of in isolation. A stock setup that looks pretty good when evaluated alone suddenly looks mediocre when you're forced to compare it against every other potential setup for the day. Scarcity forces prioritization. Prioritization forces patience. Patience creates edge. Here's a scenario that proves this in real trading conditions. You're watching three stocks Monday morning. Stock A breaks out at 9:45 a.m., 15 minutes after the open. It looks decent, not perfect. The volume is there, but not explosive. The breakout is clean, but not powerful. Under normal conditions, unlimited trades, you'd take it without much thought. It meets minimum criteria. Why not? But with the two-trade rule active, you pause. You physically pull your hand back from the mouse. You ask yourself, is this one of my two best trades today? You realize you don't know yet. It's only 9:45 a.m. You have 6 more hours of market action. If you burn trade number 1 on this marginal setup, you've used half your daily allocation on a coin flip. So you wait. You mark stock A on your chart and keep watching. At 10:15 a.m., stock B gives you something different. This is a clean pivot point entry with volume confirmation. The stock has built a base for 3 days, consolidated tightly, and now it's breaking out on twice the average volume. The risk is clear. You can place your stop. No 0.50 below the pivot. The reward is obvious. There's 2.0 of clear air to the next resistance. This is a 4-to-1 setup. Now you're certain. This is trade number 1. You execute with full conviction. You're not hoping. You're confident. That confidence comes from comparison. You've seen stock A and stock B side by side, and stock B is objectively superior. By 11 a.m., something interesting happens. Stock A, the one you almost took at 9:45, reverses. It breaks back below the breakout level and drops 1.5%. You would have been stopped out for a loss. Meanwhile, stock B is working beautifully, up 0.8% and climbing. At 1:30 p.m., stock C forms a perfect setup. It's been consolidating in a tight range all morning, and now it breaks out on a sector-wide move. Volume explodes. The pattern is textbook. You take trade number 2. Result, 2 high-conviction trades, both winners. Stock B closes up. 1.8%, you captured. 1.2% of it. Stock C closes up. 2.1%, you captured. 1.5%. Your account is up 1.35% for the day. More importantly, you finish energized, not exhausted. You made 2 decisions. You executed 2 trades. You're in control. Now contrast this with the amateur who had no rule. He took stock A at 9:45 because why not? He got stopped out by 11 a.m. for A, 0.6% loss. He took stock B at 10:15, same good trade as you, up 1.2%. But then he took 4 more setups in the afternoon. 2 scratches, 1 loss of 0.4%, 1 small win of 0.3%. He also took stock C, same as you, up 1.5%. His final tally, 7 trades, 4 winners, 2 losers, 1 scratch. His account is up 0.8% for the day. He took the same good setups you did, but his mediocre trades dragged down his performance. Plus, he's mentally fried. He made 14 decisions, entry and exit, for 7 positions. He spent 8 hours glued to his screen, stressed and reactive. The difference isn't skill or market knowledge, it's structure. He had no constraint, so he had no filter. You had a constraint, so you developed discrimination. Think of a master sculptor. He doesn't just hack away at the stone randomly. He makes very few, very deliberate strikes. He knows he can't put the stone back once he chips it away. He treats every strike as irreversible. That's how you must treat your capital allocation. Here's the paradox that breaks most traders' brains. Amateurs think freedom means unlimited choice. They want the freedom to take any trade, any time. But professionals know the truth. Freedom comes from self-imposed constraint. When you have 2 trades, you're free from the tyranny of every marginal setup. You're free from the exhaustion of constant decision-making. You're free from the guilt of missed moves. Because you know you only committed capital to your best ideas. The 2-trade rule isn't just about saving money on commissions. It's about building psychological capital. When you finish a day with 2 well-executed trades, regardless of outcome, you build self-trust. You prove to yourself that you can follow a plan. When you finish with 20 frantic trades, you erode that trust. You tell your subconscious that you're out of control. But scarcity alone isn't enough. You can limit yourself to 2 trades and still take 2 terrible ones if you don't know what you're looking for. Scarcity creates the filter, but you need to know what should pass through that filter. You need criteria. You need a definition of what constitutes an A-grade setup worthy of your scarce bullets. Not every breakout. Not every pivot. Only the setups that meet specific definable criteria that separate professionals from amateurs who are just guessing with smaller size. If you only have 2 trades to deploy in a 6.5-hour trading day, mediocrity immediately becomes your mortal enemy. You can no longer afford to throw capital at maybe trades or justify taking a B- setup because you're bored. You are now a hunter with exactly 2 rounds in your rifle, stalking a forest full of market noise. Every shot must count. You're hunting for what Jesse Livermore called pivotal points. Those specific rare moments where the market tips its hand and reveals its true intentions. Most traders think an A+ setup is just a pretty pattern on a chart. They see a bull flag or a double bottom and think they've found gold. That's amateur thinking. A pattern is just a drawing, lines on a screen that mean nothing without context. An A+ setup is a convergence event. It's when multiple independent factors, price structure, volume, time, and market context, all align to tell the same directional story at the exact same moment. Think of it like this. If trading with unlimited daily positions is like walking into an all-you-can-eat buffet where you pile mediocre food on your plate, because why not? It's all included. Then trading with the 2-trade rule is like dining at a Michelin-starred restaurant where every ingredient must be perfect. The scarcity forces quality. The constraint creates discrimination. Here is the filter you must burn into your brain. Before you click buy or sell, the trade must pass every single one of these checks. If it fails even one criterion, you pass. Remember, you only have 2 bullets for the entire day. First criterion. Clear structure with obvious support and resistance. The stock must be doing something understandable. Either it's in a clean uptrend with higher lows, a defined downtrend with lower highs, or it's range-bound with clear boundaries that any competent trader would identify. If you need 3 paragraphs to explain what the price is doing, it's not clear enough. If you have to redraw your levels multiple times to make them fit, those levels aren't real. The best support and resistance zones are where multiple traders are making decisions, previous swing highs and lows. Round numbers like 50 or 100, gap edges, moving averages that have acted as support multiple times. These are the battlegrounds where real supply and demand clash, not some obscure Fibonacci extension that only you can see. Second criterion, volume confirmation on the move you're trading. This is where most retail traders fail catastrophically. They see a breakout and jump in, but volume is average or declining. That's not confirmation. That's hope. Volume is the lie detector of price action. It tells you whether institutions are participating or if it's just retail traders pushing around a light float. Here's what real volume confirmation looks like. The stock consolidates for several days on declining volume. That's the coil building tension. Then it breaks out, and volume spikes too. 150% too. 200% of the 20-day average within the first 30 minutes. That's real money entering with conviction. Without this volume expansion, a breakout is just price wandering around with no institutional commitment behind it. Third criterion, clean risk with logical stop loss within. 2% of entry. This determines your position size and defines whether the trade is mathematically worth taking, if your stop has to be. 5% away because the structure is sloppy. You're not trading an A+ setup, You're gambling on chaos with terrible risk-reward ratios. Clean risk means there's an obvious invalidation point that any trader would recognize. For a breakout, it's below the breakout level. For a pivot bounce, it's below the pivot low. For a pullback in an uptrend, it's below the recent swing low. You should be able to point to a spot on the chart and say with certainty, if price goes there, my thesis is completely wrong. Fourth criterion, market context supports your direction. You are not trading in a vacuum. Check 3 things before you click. First, what's the overall market doing? If you're going long, you want the major indices stable or rising. Second, what's the sector doing? If you're buying a tech stock while the tech sector is bleeding, you're swimming against the current. Third, what are similar stocks doing? If peers are weak while your stock looks strong, that's actually bullish divergence worth noting. The ultimate test, the written exam. You must be able to write out the complete trade before you take it. Entry price, 50.10. Position size, 400 shares. Stop loss, 49.60. Target, 52.50 based on measured move. Risk per trade, 1% of account equals 500. If you cannot write these numbers clearly on paper before you click, it's not an A+ setup, it's an impulse masquerading as analysis. Writing forces brutal honesty. It eliminates the lies you tell yourself in the heat of the moment. When you write buying stock X at 50.10 on breakout above 50. Resistance, risking 500 with stop at 49.60, targeting 52.50. You've committed to a plan. You can't rationalize later about what you really meant to do. Here's what this discipline looks like in practice. It's Sunday night, 8 p.m. The market has been closed for 2 days. You're not watching Netflix or scrolling social media. You're scanning 200 charts, hunting for structures that could become A+ setups this week. You notice stock X, it ran 20% last month, then spent 3 weeks consolidating sideways between 48 and 50. Volume is dried up completely over the last 5 days. Classic coiled spring pattern. You write in your journal, stock X, consolidating under 50 resistance. If breaks above 50 on volume greater than 200,000 shares in first hour, will enter at 50.10. Stop at 49.50. Risk 0.60 per share. Target 52.50 based on width of consolidation. Sector is strong, overall market uptrending. This is candidate for trade 1. Monday morning, pre-market. Stock X gaps up slightly to 49.85 on sector news. Not a huge gap, just enough to keep it on your radar. You set alerts at 49.95 and 50.05. You don't sit there watching every tick. You've done the analytical work. Now you wait for the market to come to your predetermined level. At 9:40 am, 10 minutes after the open, your alert triggers. Stock X pushes through 50 and volume explodes, already at 180,000 shares, nearly half of Friday's entire daily volume. You verify the context. S&P 500 up 0.4%, sector ETF strong, 2 similar stocks also breaking out. Everything aligns. You enter at 50.12, exactly as planned 12 hours ago. This is trade number 1. You didn't react to flashing lights. You executed a business plan. Now observe what happens next. 5 other stocks are moving violently. A biotech name just spiked 30% on FD News. A semiconductor stock is crashing on earnings. The chat rooms are exploding with alerts and breaking news. Amateurs are frantically clicking, chasing every momentum spike, their heart rates spiking with each new notification. You ignore all of it. You're not interested in what's moving right now. You're interested in what you prepared for. You're waiting for your second pre-selected A+ candidate. Stock Y was on your Sunday night list. It's been building a bull flag pattern on the 15-minute chart, exactly as you anticipated. The pullback is shallow, volume is contracting, and it's holding above the 20-day moving average. At 11:15 am, stock Y breaks above the flag with a volume surge. You've been watching this setup for 36 hours. You enter at 38.65, stop at 38.20, targeting 40.80, trade number 2. Done. You close your trading platform. Your work is finished at 11:20 am. Meanwhile, the amateur is still scanning, still reacting, still taking trade number 7. He missed stock X because he was distracted by the biotech spike. He chased 3 momentum plays and got whipsawed on 2 of them. He's now down 1.2% for the day, sweating, exhausted, eyes burning from staring at screens. He's controlling nothing and reacting to everything. You are relaxed. You prepared for battle on Sunday night. Monday was simply execution. You are paid for your preparation, not your screen time. This is the professional's edge. Preparation over reaction. The amateur thinks trading happens between 9:30 am and 4 p.m. The professional knows trading happens between 8 p.m. and 9 p.m. the night before. Market hours are just for execution of pre-written plans. When you limit yourself to 2 trades, you force yourself to become a student of preparation. You can't rely on seeing something good in real time. You have to define what good looks like before the heat of battle clouds your judgment. You build watch lists of A-plus candidates. You stalk them patiently. You wait for them to trigger your predetermined levels. You don't chase price. You let price come to you. But here's the critical point that destroys even well-prepared traders. Preparation means nothing if you jump the gun. You can do all this analytical work, identify the perfect pivotal point, write out your trade plan with mathematical precision. But then in the final moment, fear takes over. You're afraid you'll miss the move. You're afraid the stock will run without you. So you buy at 49.95 instead of waiting for 50.10. You anticipate instead of confirming. Most traders fail not because they can't spot good setups. Anyone with basic education can learn to read a chart. They fail because they lack the discipline to wait for confirmation. They buy the breakout before it actually breaks. They short the breakdown before support actually cracks. And the market, being the cruel but consistent teacher it is, often reverses exactly at those anticipation points, punishing impatience while rewarding discipline. The difference between anticipation and confirmation is the difference between gambling and trading. And it's the next critical distinction that will determine whether your 2-trade rule transforms you into a professional or leaves you as a more organized amateur. Here's where most traders fail, even when their preparation is flawless. They do the Sunday night homework. They scan the charts. They identify the A-plus setups. They write out their trade plans with mathematical precision. Then Monday morning arrives, and in the final 60 seconds before execution, they throw all of that discipline out the window. They see their stock approaching the entry level and jump in early. They tell themselves they're being smart. They don't want to miss the move. They don't want to chase. They want to save a few cents on the entry. So they anticipate, and then they experience that sickening feeling you know too well, watching the stock kiss their level, fake a breakout, and reverse straight into their stop loss. This single mistake, entering on anticipation instead of confirmation, destroys more trading accounts than bad stock selection, poor risk management, or even over-leveraging. It's the silent killer that turns winning systems into losing ones, and it happens because traders confuse being early with being smart. The amateur anticipates. The professional waits for confirmation. That sentence isn't motivational fluff. It's a mathematical dividing line between traders who consistently donate to the market and those who quietly withdraw money from it. You need to understand what confirmation actually means, because most traders think they get it, but really don't. Confirmation is not the stock approaching your level. It's not touching your level. It's not looking strong or giving you a gut feeling. Confirmation means the stock has done what you explicitly said you wanted it to do before you would commit capital. If you're waiting for a breakout above 50 resistance, confirmation means the stock has actually traded above 50 with authority, not 49.98 for one tick, but clearly and decisively above 50. It has held above that level for several bars on your time frame, proving the breakout isn't just a momentary spike. And it has shown volume expansion, evidence that real money is participating in the move, not just a few retail traders pushing around a thin float. Think of the resistance level as a locked door. Anticipation is buying as someone reaches for the doorknob, hoping it will open. Confirmation is waiting until the door is fully open and people are walking through. One is guesswork based on hope. The other is observation based on evidence. Jesse Livermore, The greatest speculator in history paid for this lesson with millions of dollars. Early in his career, he would anticipate pivotal points. He'd see a stock building toward a breakout and think, I know where this is going. Why wait and pay more? So he'd enter early, trying to get the perfect price. Sometimes he was right. Often he was wrong. The times he was wrong wiped out everything he'd made when he was right. It took multiple bankruptcies before he accepted the brutal truth: the market doesn't reward you for being early. It rewards you for being right. Being early and being wrong produce the exact same financial result. You lose money. Your account statement doesn't care about your clever timing predictions. It only cares whether the trade worked. The two-trade rule makes confirmation discipline easier to enforce through pure psychological mathematics. When you have unlimited trades, wasting one on anticipation feels cheap. Oh well, I jumped the gun. I'll just take another trade. There's no immediate consequence except the loss. But when you only have 2 trades for the entire day, the stakes become brutal. If you burn trade number 1 on an anticipated move that fails, you've wasted 50% of your daily allocation on a rule violation. You've cut your opportunity in half because you couldn't wait 60 more seconds for proof. That psychological weight forces better behavior. You start treating each entry like a surgeon making an incision. You don't cut until you're absolutely certain where to place the blade. Here's the scenario that plays out thousands of times daily across trading accounts worldwide. Stock Z has been consolidating below 50 resistance for 3 days. It's a textbook pattern with contracting volume, a coiled spring. You've identified this as your primary A+ setup. Your written plan says, buy at 50.10 on breakout above, 50 with volume confirmation. Stop at 49.60. Target 52.50. At 10:00 am, stock Z is trading at 49.80. It's moving higher from the morning lows. 49.82, 49.85, 49.88. Your heart rate increases. This is the moment you've been preparing for. The amateur's brain starts its familiar rationalization. It's so close to 50. It's obviously going to break out. Why wait and pay more? I'll save 20 cents and get in now at 49.80. That's better execution, right? Wrong. That's not better execution. That's anticipation disguised as skill. The amateur buys at 49.80. The stock continues higher. 49.92, 49.96, 49.99. He feels brilliant. Then it touches 50.02 for exactly 1 5-second candle and immediately reverses. 49.85, 49.70. Within 3 minutes, it's back at 49.50. His stop gets hit at 49.42. Let's calculate the damage. He entered at 49.80 and was stopped out at 49.42. That's at 0.38 loss per share. On a 10,000 account risking 1% per trade, he's trading roughly 260 shares. So that's about 99, or essentially 1% of his account gone. More importantly, he's burned trade number 1 on a rule violation. His entire day is compromised because he couldn't wait for confirmation. The professional watches the exact same price action. He sees stock Z at 49.80 rising toward 50. He feels the same urge to jump in early. He's human. FOMO hits him too. But he's trained himself to wait. He literally moves his mouse away from the buy button. This is discipline in action. At 10:05 am, stock Z touches 50.02 and reverses. The professional watches it drop back to 49.60. He feels relief, not regret. His discipline just saved him from a losing trade. He still has both bullets loaded. At 10:30 am, stock Z makes another run at 50. This time something is different. It breaks above 50 with real force. 50.05, 50.12, 50.18. It holds above 50 for 3 consecutive 5-minute bars, each bar closing higher than the last. Volume explodes to 250,000 shares in those 15 minutes, double the recent average. This is confirmation. Real money is participating. Institutions are involved. The professional enters at 50.05. Yes, he paid 0.25 more than the amateur's 49.80 entry. He overpaid by 65 on 260 shares. But here's what happens next. Stock Z, now free of the overhead supply at 50, accelerates 50.30, 50.55, 58.5 by 11:30 am. It's trading at 51.20. He exits according to his plan at 51.5, capturing 110 per share. On 260 shares, that's 286 or 2.86% of his account. Compare the results. The amateur saved 0.25 per share by entering early. 65 savings on his position size, but he lost 99 on the failed trade. Net result, down 99. The professional overpaid by 0.25 per share. 65 cost, but he made 286 on the confirmed trade. Net result up 286. The amateur saved pennies and lost dollars. The professional spent pennies and made dollars. This is the brutal mathematics of confirmation versus anticipation. Here's the deeper truth most traders never grasp. When you anticipate, you're trading your hope about what the market might do. When you wait for confirmation, you're trading the market's actual behavior. Hope is not an edge. Behavior is data you can act on. Think of confirmation as an insurance premium. You pay a small amount up front, entering slightly later at a slightly worse price in exchange for dramatically higher odds that the move you're paying for is real, not a head fake. It's like crossing a busy street. Anticipation is stepping off the curb because you think a gap in traffic might open up. Confirmation is waiting for the walk signal. Yes, waiting costs you 10 seconds. But you arrive alive. Every time you pay up for confirmation, that extra 5, 10, or 20 cents per share, you're buying the most valuable insurance policy in trading, proof that buyers have actually defeated sellers at that crucial price point. Professional traders are happy to pay this premium because they think in probabilities, not prices. Amateurs obsess over getting the perfect entry price and end up owning the perfectly wrong trade. The two-trade rule amplifies this lesson through scarcity psychology. When you know you can only pull the trigger twice all day, you naturally become more selective about entry quality. You stop asking, how much can I make if I get in now? And start asking, is this move actually real? You transform from someone trying to predict the market to someone following what the market is actually doing. This shift changes your entire relationship with trading. You stop trying to outsmart the market or anticipate its next move. You start letting the market lead while you follow. It breaks out. You enter. It breaks down. You exit. You surrender the ego need to be first to the party and settle for being the one who stays for the main event. Tomorrow, when you sit down with your 2 precious bullets, make this pact. You will not fire until you see proof. You will not buy because the price is close to your level. You will not enter because it looks like it's going to work. You will wait for the actual breakout. You will wait for the volume confirmation. You will pay the small insurance premium of a slightly worse price in exchange for the massive advantage of much higher probability. Once you've mastered this art of waiting for confirmation, and you find yourself in a trade that's actually working, not because you guessed right, but because you waited for proof, you face the final and most sophisticated challenge of professional trading. You're in position. You're profitable. The confirmation worked exactly as planned. Now the question becomes, how do you maximize this validated opportunity without giving back your gains? How do you size positions correctly from the start, and critically, when do you earn the right to press your advantage by adding to a winner? This is where position sizing and the lost art of pyramiding separate the good traders from the great ones. You've prepared your watch list on Sunday night. You've waited patiently for confirmation Monday morning, resisting the urge to anticipate. You've taken position at exactly the right moment when the market proved your thesis correct with price and volume. Now comes the part that quietly separates good traders from truly great ones, position sizing and pyramiding. This is where most traders who do everything else right still leave massive money on the table, or, worse, turn winning trades into disasters. When you have unlimited trades available, you can afford to be sloppy with size. It's a subconscious leak that kills accounts slowly. You take small feeler positions because you're not fully convinced, thinking you'll add more later if it works. Or you take oversized positions when you're feeling confident, planning to balance them out with other trades if things go wrong. You're using activity to mask the fact that you have no sizing discipline whatsoever. The two-trade rule kills that escape route permanently. You can't lean on "I'll just take another trade" anymore. You've only got 2 bullets for the entire day. Each shot must be sized like a professional, because there's no room for error, no opportunity to diversify away your mistakes with more activity. That pressure is exactly what forces you to become deliberate about risk. Here's the protocol that will feel uncomfortable at first because it removes all wiggle room. Risk exactly. 1% of your capital per trade. Not per position, not per day, not around. 1% when you're feeling conservative. Exactly. 1% per trade. If your account is 50,000, your maximum loss on any single trade is 500, including slippage and commissions. If it's 100,000, you risk 1,000. This number is fixed before you look at any chart, any news, any setup. Your emotions don't get a vote. From there, your stop distance determines your share quantity, not your opinion about how much you want to make or how bullish you feel about the setup. The formula is brutally simple. Position size equals risk amount divided by stop distance. This mathematical relationship will become your discipline enforcer because it removes guesswork from the equation. Let's make this concrete with real numbers. You have a 50,000 account, so you're risking 500 per trade. Stock A is breaking out at 50, and your stop loss based on the pivot structure is at 49. Your stop distance is 1.0 per share. Plug it into the formula. 500 divided by 1.0 equals 500 shares. That's your position size. Not 600 shares because you're feeling confident. Not 400 shares because you're scared. Exactly 500 shares. Now consider stock B. Same account, same. 500 risk allocation. But stock B is breaking out at 100, and the logical stop based on the technical structure is at 98. Your stop distance is 2.0 per share. The formula gives you 500 divided by 2.00 equals 250 shares. Notice what happened. The higher priced stock with the wider stop automatically gave you fewer shares. The math protected you from over-leveraging just because you liked an expensive stock. This is how professionals think. They don't ask, how many shares should I buy? They ask, what's my risk and what's my stop? The position size is the mathematical output of that equation, not a guess based on gut feeling. You've normalized your risk across different volatilities and price levels, whether you're trading A, 20 stock, or A, 200 stock, your maximum loss remains exactly 500. The market can't hurt you more than you've predetermined you're willing to lose. The amateur sees stock B at 100 and thinks, I can only afford 250 shares? That's not enough to make real money. I'll buy 500 shares and just use a tighter stop at 99. Now he's committed two fatal errors. First, he's risking 1,000 instead of 500, double his risk rule. Second, he's placed his stop based on his position size desires rather than on the actual market structure. When stock B pulls back to 99.20 in normal volatility, he gets stopped out. He lost 1,000 on a trade that should have worked if he'd followed the math. The professional with his mathematically determined 250 shares watches that same pullback to 99.20. He's down. 200 on paper, uncomfortable but manageable. The stock bounces back above 100, confirming the structure is holding. By day's end, it's at 103. He's up 750. Same setup, same market action, completely different outcomes, because one trader followed the math while the other followed his emotions. Now we get to the sophisticated part that builds real wealth: pyramiding. This is the lost art that Jesse Livermore mastered and that modern traders have completely abandoned in their obsession with diversification. If your first trade works, and you're up 1% on your account, meaning the position has moved significantly in your favor and you're sitting on open profit, you can use your second trade allocation to add to that winning position. This is how professionals build significant gains from high-conviction ideas. They don't go all in at the initial entry like gamblers. They prove the position first with mathematically controlled size, then scale in as the market confirms they're right. Livermore called this pyramiding on a profit basis. The rule is ironclad: never ever add to a losing position. Only add to a confirmed winner that's giving you tangible proof you're on the right side of the market. Here's what this looks like in practice. Monday at 10:30 a.m., you enter stock X at 50.05 after it breaks out with volume confirmation. You're risking 500 with a stop at 49.50, so you bought approximately 900 shares. By 11:45 am, stock X is trading at 51.0. You're up 0.95 per share, roughly 8.55 or 1.7% of your account. The stock is showing continued strength, holding gains, volume remaining elevated, making higher lows on the 5-minute chart. This is when you earn the right to use your second trade allocation. You add 500 more shares at 51 row. Your new average price becomes approximately 50.40 on 1,400 total shares. Critically, you move your stop on the entire position to 50.20, above your original entry, locking in a worst-case break-even scenario. Now if StockX continues to 53, you're making 2.60 per share on 900 shares and 2.0 per share on 500 shares. That's 3,340 total profit, or 6.7% of your account on a single idea that proved itself worthy. The amateur sees this result and thinks you got lucky. The professional knows you followed a systematic protocol. Prove it first with standard size. Add only to winners showing profit. Protect your capital with trailing stops, and let the market pay you for being right. Here's the beauty of the two-trade rule in this context. It naturally prevents over-pyramiding disasters. You can't keep adding and adding because you only have 2 trades total. If you use trade 1 for the initial entry and trade 2 to pyramid, you're done. You can't get greedy and add a 3rd, 4th, 5th time until you've over-leveraged a good trade into a catastrophic loss. The constraint protects you from your own enthusiasm and greed. This protection is critical because the most common way traders destroy themselves isn't by being wrong, it's by being right, then getting carried away. They enter a winner, it works. They add, it works more. They add again and again until they're so leveraged that a normal 2% pullback wipes out everything they made, and more. The two-trade rule acts as a circuit breaker against this self-destruction. Think about the mathematical elegance here. With 2 trades, you have exactly 3 position sizing options. Option 1. Take 2 completely separate positions in different stocks, risking 1% on each for maximum diversification. Option 2. Take 1 position with your first trade, and if it proves itself profitable, pyramid with your second trade for maximum concentration. Option 3. Take 1 position only and hold your second trade in reserve for a different setup later in the day. Each option is valid depending on market conditions and setup quality. The constraint forces you to choose deliberately rather than reactively. Compare this to the amateur approach. He wants 10 trades at 0.5% risk each, thinking he's being conservative and diversified. But what really happens? He takes 10 mediocre setups because he needs to fill his activity quota. He gets whipsawed on 6 of them, makes small gains on 3, and has 1 decent winner. His total risk exposure across all positions is 5%, but it's spread so thin across weak ideas that he captures almost no meaningful profit from the winner. He finishes the day exhausted, down 0.8%, wondering why he can't get traction despite all his hard work. The professional wants 2 trades with the potential for 2.5% gain on each. He's not risking more total capital, he's still risking 1% per individual trade decision. But by concentrating his capital on his 2 highest conviction ideas and pyramiding the one that proves itself, he captures 5% or more when he's right. Same risk exposure, concentrated execution, completely different results. You don't get rich trading more. You get rich trading bigger when you're right. That sentence should be burned into every trader's consciousness because it represents a fundamental identity shift from amateur to professional thinking. The amateur thinks activity equals opportunity. He measures success by how many trades he took, how busy he stayed, how much screen time he logged. The professional knows conviction equals profit. He measures success by how well he executed his highest probability ideas with appropriate size when the market confirmed he was right. When you combine the 2-trade rule with precise position sizing and disciplined pyramiding, you transform from someone who's gambling with vague plans into someone who's executing a business with defined protocols. You prepare on Sunday. You wait for confirmation on Monday. You size based on mathematics, not emotions. You pyramid based on proof, not hope. You protect with trailing stops based on structure, not fear. You finish the day having made 2 critical decisions instead of 20 impulsive ones. This is what earning your volume means. You don't start with huge size hoping to get lucky. You start with mathematically controlled size and let the market decide whether you deserve to go bigger. Your ego is no longer in charge of position sizing. Your profit and loss statement makes that determination based on objective market behavior. As you practice this discipline, you'll notice something profound shift in your emotional relationship with trading. Your daily volatility drops dramatically. You're no longer swinging between euphoric big wins and devastating big losses. Your downside is capped by mathematics. Your upside, when you write and scale properly, becomes meaningfully larger than your typical loss. Over time, this asymmetric risk-reward profile has no choice but to tilt the probabilities in your favor. But even with perfect preparation, flawless confirmation, mathematical position sizing, and disciplined pyramiding, there's still one element that determines whether all of this structure holds together or crumbles under pressure. There's an invisible trade you make every single day that never shows on your platform, never appears on your statement, but quietly determines everything. It's the decision about who you are and what you're willing to become after you've taken your 2 trades and closed your platform for the day. In the final chapter, we'll close this loop and reveal why your identity, not your strategy, is what ultimately determines whether you ever master this game. Let's close the loop. From the very beginning, I told you there was a third, invisible trade you make every single day. You've seen the first 2 trades. They show up on your blotter, appear on your statement, generate confirmation emails. You can screenshot them, analyze them, brag about them, or learn from them. But the third trade never appears anywhere. It has no ticker symbol, no entry price, no stop loss. Yet it's the most important position you'll ever take, because it determines everything that follows in your trading career. Every single day, the moment after you've deployed your 2 allocated trades, win, lose, or scratch, you place one final, massive position. You either go long your ego, or you go long your process. There is no neutral ground. You are choosing one or the other, consciously or unconsciously, and that choice shapes your identity as a trader more than any technical analysis or market knowledge ever will. If you go long your ego, the script is painfully predictable and devastatingly consistent. It's 1:30 p.m. You've taken your 2 trades for the day, maybe you're up. 0.6%, maybe you're flat, maybe you're down. 0.4%. Then you see it, a stock breaking out with explosive volume. It's ripping higher, up. 3% in 5 minutes. The chat rooms are exploding with alerts. Your heart rate spikes. The familiar voice in your head starts its seductive negotiation. This is different. This is a once-a-week setup. The 2-trade rule is just a guideline, not a prison sentence. I'd be stupid to miss this. Look at that volume. Institutions are clearly involved. I'll just take this one additional trade. And tomorrow I'll be extra disciplined to make up for it. Who's going to know? It's my money, my rules. So you override the constraint. You tell yourself you're being flexible, adaptive, intelligent. You're not following rules blindly like some algorithmic robot. You're thinking for yourself, making real-time adjustments based on market conditions. You click buy. You take trade number 3. Here's the truly insidious part. Sometimes you'll even win. The stock continues its rampage. You capture 1.2% of the move, and you finish the day up. 1.8% total. You feel brilliant. You've just proven to yourself that rigid rules are for amateurs, and that breaking your constraints when it really counts is actually the intelligent, professional thing to do. That victory is the most dangerous outcome in all of trading, because you've just conditioned yourself like a laboratory rat. When you press the break discipline button, the market dispensed a food pellet. Your nervous system doesn't care about long-term statistics, risk of ruin, or systematic edge. It cares that rule-breaking felt good and got rewarded immediately. Your brain has now encoded a lethal lesson: breaking my rules makes money. You've just reinforced the exact behavior pattern that will eventually destroy your account. It won't happen tomorrow or next week, but it's coming with mathematical certainty. Because the next time you see a can't-miss setup after your 2-trade limit, you'll remember this win. The memory will whisper in your ear, "Remember last time you broke the rule. That worked beautifully. Do it again." You'll override the constraint again and again. Within 2 weeks, the 2-trade rule has become the 2 to 5 trade suggestion, and you're right back where you started, overtrading, exhausted, bleeding capital through 1,000 small cuts, while telling yourself you're being flexible. If you go long your process instead, the exact same scenario unfolds completely differently. Same setup, 1:30 p.m. You're up 0.6% for the day. That explosive stock is breaking out on your screen with massive volume. You feel the identical urge. FOMO hits you just as hard because you're human, not a machine. But here's where the professional diverges from the amateur. You recognize the urge for what it truly is. You name it. This is my ego, wanting to be right about one more trade. This is my addiction to action, trying to override my systematic edge. You stop at 2. You physically close your trading platform, or, at minimum, you step away from your desk. You accept that today will be an incomplete day. You won't capture every move. You won't maximize every opportunity. You won't have the biggest number in the trading chat room. Instead, you measure success by a different metric entirely. Did you keep your decisions within your predetermined risk framework? Did you honor the contract you signed with yourself? Did you stay in your lane and follow your plan when it was uncomfortable to do so? You went long your process instead of your ego. The payout for this trade isn't immediate cash in your account. The payout is self-respect. The payout is the psychological callus you're building that makes you harder to shake tomorrow. The payout is the identity transformation from someone who talks about discipline to someone who lives it. This is the identity shift that changes everything. The amateur thinks their job is to trade, to click buttons, generate activity, be in the action, maximize screen time. They believe they're paid for effort, for hours logged, for the number of decisions they make. The professional knows their job is to filter. They understand they're paid for selectivity, for saying no to mediocrity, for protecting capital until the truly exceptional opportunity appears. They know that cash is inventory, and every bad trade represents damaged goods that can never be sold at full price. For the amateur, waiting feels like torture. It feels like punishment, like missing out, like not doing their job. For the professional, waiting transforms into an active position. It becomes a strategic choice with real economic value. Doing nothing is doing something very specific, preserving capital for a higher probability moment while maintaining the psychological discipline that creates edge. When you truly follow the 2-trade rule, the hours after your trades become the most valuable training ground you have access to. You don't just walk away feeling smug about your discipline. You do the analytical work that separates professionals from everyone else. You journal every emotion you felt during execution. You capture screenshots of your trades at entry and exit. You document your wins without ego and your losses without shame, asking only the questions professionals care about. Did I follow my rules? Did I execute my process cleanly? Then you do something even more valuable that most traders never consider. You mark every chart where you almost clicked a third time. Every setup that tempted you. Every stock that made your finger hover over the buy button. You circle those ghost trades, the ones your ego wanted, but your process forbade. Then you ask yourself the question that reveals uncomfortable truth. If I had unlimited trades today, what damage would I have done? Track this honestly for 1 month, and you'll discover something profound and humbling. You'll see that 70 to 80% of those impulse trades, the third, fourth, and fifth ideas that felt so compelling in the moment, would have been losers. That explosive breakout at 1:30 p.m. that you wanted so desperately, check the chart at the close. It reversed by 2:15 p.m. and finished below the breakout level. You would have been stopped out for A. 0.7% loss, turning your 0.6% winning day into a 0.1% scratch. Your discipline didn't cost you opportunity, it saved you from giving back your gains to your own impatience. Every avoided loser is mathematically identical to a winner in terms of its impact on your bottom line. Let that truth penetrate, because most traders never internalize it. They only count their wins and losses, never the disasters they avoided through disciplined inaction. If you make 1,000 on a winning trade, that's obvious value creation. But if your discipline prevents you from taking a trade that would have lost 800, you've created 800 of invisible value. Your account statement doesn't show a line item for money not lost through discipline, but that invisible value compounds over time into the difference between consistent profitability and perpetual struggle. The market is a mechanism that transfers money from the impatient to the patient, but it operates on a delay that breaks most traders psychologically. The market pays you in money only after it tests you in discipline. This is the sequence every successful trader must pass through, and there are no shortcuts, no exceptions, no special cases. First, the market tests whether you can follow your own rules when it's uncomfortable, when you're missing moves, when you feel left out, when the chat rooms are celebrating gains you didn't capture. Only after you've proven you can pass that test consistently does the market begin making regular deposits into your account. The discipline comes first, always. The profits follow, never the reverse. Your action plan from here is brutally simple, though not easy. Tomorrow morning, you are implementing the two-trade rule with full commitment. Not next week, when you feel more prepared. Not after you finish reading 3 more trading books. Tomorrow. Tonight, before you sleep, you do your preparation work. You scan your watch list with fresh eyes. You identify 2 to 3 A+ setup candidates that meet every criterion we've established. You write out your complete trade plans, entry levels, stop losses, position sizes calculated by the formula, profit targets based on measured moves. You set your alerts. You go to bed knowing exactly what you're hunting for and what constitutes confirmation. When the market opens tomorrow, you won't be reactive. You won't be scanning for hot stocks or chasing momentum alerts. You'll be waiting like a sniper for your predetermined levels to trigger. You'll wait for confirmation, actual breakouts, not anticipated ones. When you get that confirmation, you'll execute with full conviction at your planned size. Then, whether you've taken 1 trade or 2, whether you're up money or down, whether it's 10:30 a.m. or 3:30 p.m., you honor your constraint. You close your platform. You walk away. You resist the urge to optimize or stay flexible. You're going to feel withdrawal symptoms. You're going to feel bored, restless, like you're not working hard enough. That discomfort is not a bug in the system. It's a feature. That's the feeling of your addiction to activity slowly dying. That's the feeling of your professional identity being born from the ashes of your amateur impulses. Cut losses fast. Size small. Wait for confirmation. Own your process. These 4 principles, enforced by the ironclad constraint of the two-trade rule, will transform your trading. Not overnight. Anyone promising overnight transformation is selling you fantasy. But they will transform you consistently, systematically, profitably. They'll stop the bleeding that's been slowly draining your account. They'll stabilize your equity curve. They'll give you back your sanity and self-respect. And in trading, consistency is the only edge that ultimately matters, because consistent traders can scale their success, while inconsistent traders with occasional big wins are just gamblers riding temporary luck. If this resonated with you, if you felt that uncomfortable sting of recognition when I described the bleeding, the anticipation, the ego trades, then you're ready for this constraint. You've learned how to stop the hemorrhaging by trading less. You've learned how to filter for quality over quantity. You've learned that your job is not to catch every move, but to catch the right moves with appropriate size and disciplined execution. But defense is only half of professional trading. Once you've stopped the bleeding and stabilized your account through disciplined constraint, you need to know how to attack when the rare, perfect moment arrives. You need to understand how to take that exceptional A+ setup that passes every filter and extract maximum profit from it, without increasing your fundamental risk. Your next lesson is clear. You've learned to trade less. Now we'll explore how to press your winners like a professional. We'll dive deep into the sophisticated mechanics of pyramiding, how to add size to a confirmed winner, so that when your 2 daily bullets find their mark, you don't just make a living, you build lasting wealth. That's the next step in your evolution from amateur to professional. But first, master this constraint. Go long your process. I'll see you in the next session.